There is one single date on the calendar that quietly decides whether you keep tens of thousands of dollars or hand them straight to the IRS, and it is not April 15th. It is December 31st. For anyone with a six-figure retirement account, an IRA, a 401k, a 403b, the last day of the year is the most important financial deadline you have because there are at least 5 separate tax traps built into the system that can only be fixed before the clock runs out on December 31st. After that, the door closes. The money is gone. There is no amending it in April, no fixing it next year, no second chance. And here is what makes these traps so dangerous. Every one of them targets exactly the people who did everything right, the careful savers, the people who spent 30 or 40 years quietly building a real nest egg. The bigger your account, the harder these traps hit, because the dollar amounts scale with the size of what you have built. A retiree with $1 million in an IRA can lose more to a single one of these mistakes than a younger worker earns in an entire year, and almost none of it is explained to you anywhere because there is no form, no warning letter, no friendly reminder. The deadline simply arrives, and either you handled it or you did not. In the next 25 minutes, I'm going to walk you through all 5 of these traps, one at a time, exactly how each one drains a six-figure account, the precise dollar cost of getting each one wrong, and the specific move you have to make before December 31st to shut each trap down. Nothing in this video is financial or tax advice. Talk to a credentialed tax professional before you make any year-end moves with your retirement accounts. Trap number 1. The required minimum distribution deadline and the brutal penalty hiding behind it. Here is the rule. Once you reach age 73, the federal government no longer lets you leave your traditional retirement money sitting untouched. Every year, you are forced to withdraw a minimum amount from your traditional IRA, your 401k, your 403b, whether you need the money or not. This is called your required minimum distribution, your RMD for short, and the deadline to take it is December 31st every single year. Miss it, and the penalty is among the harshest in the entire tax code. The IRS charges an excise tax of 25% on whatever amount you failed to withdraw. Let me say that again because people do not believe it the first time they hear it. If your required distribution for the year was $20,000 and you simply forgot to take it, the penalty is 25% of that $20,000, which is $5,000, and that is on top of the regular income tax you still owe when you finally do take the money out. Now, there is a small mercy built into the law. If you catch the mistake and correct it within 2 years by withdrawing the missed amount and filing the right form, the penalty drops to 10%, but 10% of a missed distribution on a large account is still thousands of dollars gone forever for nothing more than a paperwork mistake. Here is how this trap drains a six-figure account specifically. Your required distribution is calculated by taking your account balance as of December 31st of the prior year and dividing it by a life expectancy factor from the IRS table. At age 73, that factor is 26.5. So a retiree with $500,000 in a traditional IRA has a required distribution of $500,000 divided by 26.5, which comes to about $18,800 in that first year. A retiree with a full $1 million has to pull out nearly $38,000. And here is the cruel part that almost nobody plans for. That factor shrinks every single year as you age, which means the percentage of your account you are forced to withdraw keeps climbing year after year, even if your balance stops growing. The bigger the account, the bigger the forced withdrawal, the bigger the tax bill, and the bigger the penalty if you ever miss the deadline. There is one more piece of this trap that catches people in their very first RMD year, and it is expensive. The rules give you a one-time option to delay your very first required distribution until April 1st of the year after you turn 73. That sounds like a nice little break. It is usually a trap, because if you delay that first one until April, you still have to take your second required distribution by December 31st of that very same year, which means you are forced to take 2 full years of distributions inside a single tax year. 2 distributions stacked into 1 year can balloon your income, push you into a higher tax bracket, and, as you will see in just a moment, set off a whole separate trap with your Medicare premiums. For most people, taking that first distribution on time, in the year you turn 73, is the smarter move. So here is your fix before December 31st. If you are 73 or older, confirm that you have taken your full required distribution for the year from every single traditional retirement account you own. Do not assume your brokerage did it automatically. The IRS holds you personally responsible, not your custodian. If you have several IRAs, the rules let you add up the total requirement and take it from any combination of them, but the full amount has to come out before the deadline. Pull up each account, confirm the exact dollar figure that came out, and make sure it meets or exceeds your required minimum. This is 15 minutes of work that protects you from a 25% penalty. There is no higher return 15 minutes anywhere in your financial year. Trap number 2, IRMA A bracket creep, the Medicare surcharge that punishes you for a number you set 2 years ago. This one is genuinely sneaky because the damage is completely invisible at the moment you cause it and only shows up 2 years later when it is far too late to undo. IRMA A stands for the Income-Related Monthly Adjustment Amount, and it is a surcharge piled on top of your Medicare premiums when your income climbs above certain thresholds. Here is the part that makes it so dangerous. It is based on your income from 2 years prior, so your Medicare premiums in 2026 are based on the income you reported on your 2024 tax return. And the income you generate this year before December 31st will determine your Medicare premiums 2 years from now. You are setting a bill today that you will not see arrive until 2 years down the road. Now here is what makes IRMA A uniquely cruel compared to an ordinary tax. A normal tax bracket is gradual. If you go $1 into a higher bracket, only that $1 gets taxed at the higher rate. IRMA A does not work that way at all. IRMA A is a cliff. The moment your income crosses a threshold by even a single dollar, the entire surcharge for that tier kicks in, all at once, on the whole thing. For 2026, the standard Medicare Part B premium is $202.90 a month. The first IRMA A threshold hits at a modified adjusted gross income of $109,000 for a single filer or $218,000 for a married couple filing jointly. Cross that line by $1 and your Part B premium jumps by over $80 a month per person, with a Part D drug surcharge stacked on top. For a married couple, where both spouses pay it, crossing that very first threshold by a single dollar costs the household roughly $2,300 a year. And it climbs sharply from there. At the higher tiers, the total Part B premium can reach nearly $690 a month per person. A couple sitting deep in the upper brackets can pay close to $10,000 a year in Medicare surcharges alone. Here is how it drains a six-figure account. Remember trap number 1, that required distribution? That forced withdrawal counts as income. So does a Roth conversion, so does a capital gain, so does the interest on your bonds, including, importantly, the tax-exempt interest on municipal bonds, which IRMA A adds right back in. All of it stacks up into the number IRMA A looks at, which is your adjusted gross income plus that tax-exempt interest. The retiree with a large traditional IRA gets hit twice over. The big account forces out a big required distribution, and that big distribution shoves their income up toward or straight over an IRMA A cliff. People cross these thresholds not because they suddenly got richer, but because the government forced money out of their account that they never even wanted to withdraw. So here is your fix before December 31st. Know exactly where you stand relative to the next IRMA A threshold for this tax year, because this year's income is what sets your premiums 2 years out. Add up your expected income for the year, your required distributions, any conversions, your capital gains, your taxable and tax-exempt interest. If you are sitting just under a threshold, do not casually take an extra withdrawal or realize an extra gain that knocks you over the cliff for the sake of a few $100s, because the surcharge it triggers can cost you thousands. If you are already over a threshold by just a small amount, look hard for legitimate ways to bring your income back down before year-end, which is exactly where the next 3 traps come in, because 2 of them are the most powerful tools you have for managing this very number. And one more thing almost nobody knows. If your income spiked because of a one-time life event, the sale of a home, the loss of a spouse, your own retirement, you can appeal an IRMA A surcharge using a form called SSA 44. Most people never find out that appeal even exists until years after they could have used it. Trap number 3, the Roth conversion window that slams shut on December 31st. This one is different from the others because it is not a penalty you are trying to avoid. It is an opportunity that quietly expires. And for the retiree with a large traditional account, missing this window year after year is one of the most expensive slow-motion mistakes in all of retirement planning. Here is the setup. Every dollar sitting in your traditional IRA or 401k is money you have never paid income tax on. The government is your silent partner on that account, patiently waiting to collect its share. A Roth conversion is the move where you voluntarily take money out of the traditional account, pay the income tax on it now, and move it into a Roth account, where it then grows completely tax-free for the rest of your life and is never subject to required minimum distributions. The whole game is to do these conversions during your lower income years, paying tax at a low rate now so you avoid being forced to pull that money out later at a higher rate through required distributions. The best window for this is usually the stretch of years between when you retire and when required distributions begin at 73. In those gap years, your income is often at the lowest point it will ever be, which means there is room underneath your tax bracket to convert money cheaply. And here is the trap. A Roth conversion only counts for a given tax year if it is fully completed by December 31st, not April 15th, December 31st. Unlike a regular IRA contribution, which you can make right up until the tax filing deadline in April, a conversion is locked to the calendar year it happens in. So every year that passes without using up that low bracket room is a year of cheap conversion space you can never get back. The room does not roll over to next year, it simply vanishes. Let me put real numbers on it. Imagine a 67-year-old couple, recently retired, living on Social Security and a small pension, with $800,000 sitting in a traditional IRA. Their taxable income this year is low enough that they have room to convert $60,000 and still stay inside the 12% federal bracket. If they do it before December 31st, they pay about $7,000 in tax and move a full $60,000 into the Roth, where it will never be taxed again and never force a distribution on them. If they skip it, that $60,000 stays in the traditional account, keeps growing, and eventually comes roaring out as a required distribution in their late 70s and 80s, very possibly taxed at 22% or higher, and very possibly shoving them over an IRMA A cliff in the process. Now multiply that single decision across 10 gap years, and you are looking at a six-figure difference in lifetime taxes. But every single year, you have to act before the deadline, or that year's opportunity is simply gone for good. One important caution that ties straight back to trap number 2. A Roth conversion raises your income in the year you do it, which means a large conversion can trigger an IRMA A surcharge 2 years later. The art of it is to convert as much as you can comfortably fit under your target tax bracket without recklessly blowing through an IRMA A cliff. This is exactly the kind of calculation worth running carefully with a professional before you pull the trigger, and worth running well before December 31st, not in a panic on the last day of the year. Trap number 4. The qualified charitable distribution, the single most efficient charitable move in the entire tax code, the one that most charitable retirees never use, and the one that also expires on December 31st. If you are at least 70 and a half years old, and you give to charity, even just a little, this one can save you money on 2 separate fronts at the same time. Here is how it works. A qualified charitable distribution, a QCD, lets you send money directly out of your traditional IRA to a qualified charity. For 2026, you can send up to $111,000 per person this way. And here is the real magic of it. That money never counts as income to you. It is not a deduction you have to itemize and hope to use. It is an exclusion, which is far more powerful. The dollars simply never appear on your tax return as income in the first place. Now connect that to everything we have already covered. Remember that required minimum distribution from trap number 1, the one that gets forced out and counts as income? If you direct that money to charity through a QCD, it counts towards satisfying your required distribution, but it does not count as income to you at all, which means it does not inflate the number that IRMA A is watching. The QCD is the one tool that lets you satisfy your forced withdrawal, support your church or your favorite charity, and hold your Medicare premiums down, all in a single move. Here is the contrast that shows why it matters so much. Imagine a retiree with a required distribution of $30,000 who also gives $10,000 a year to her church. The old way, she takes the full $30,000 as income, all of it inflating her adjusted gross income and her IRMA A exposure, and then she tries to deduct the $10,000 donation, which she usually cannot fully use anyway because she takes the standard deduction, like the vast majority of retirees do. The QCD way, she instructs her IRA to send $10,000 directly to the church. That $10,000 counts toward her $30,000 required distribution, so she only has to take the remaining $20,000 as income. Her reported income drops by $10,000. Her IRMA A exposure drops. The portion of her Social Security that gets taxed may drop as well, and the church receives the exact same amount it always did. She did not lose a single thing, and she protected herself from two separate traps at once. And here is the deadline piece. For a QCD to count for this tax year, the money has to actually leave your IRA and reach the charity by December 31st. If you wait until late December, you have to leave time for your custodian to process the request and for the check to actually clear into the charity's hands. People who try to squeeze this into the last week of December sometimes discover the transaction does not complete in time, and then it counts for the wrong year, or it fails to satisfy the current year's required distribution. Do not wait until the final days. If you are charitable and you are over 70 and a half, this is the move, and the time to start it is well before the deadline, not on December 30th. Trap number 5, capital gains harvesting, the year-end move that works in two completely opposite directions depending on your situation, and both directions close on December 31st. This trap is really two opportunities wearing the same coat, so let me take them one at a time. The first version is tax gain harvesting, and it is for the retiree whose income is low enough to reach into the 0% capital gains bracket. Here is the rule almost nobody takes advantage of. For 2026, if your total taxable income is below $98,900 for a married couple or $49,450 for a single filer, your long-term capital gains are taxed at 0%, not a low rate, 0. So in a low-income year, especially those gap years before your required distributions begin, you can deliberately sell appreciated investments, lock in the gain, pay 0 federal tax on it, and then immediately buy the investment right back at the new higher price, which resets your cost basis upward so you owe far less when you eventually sell it for real. It is a completely legal reset button on your future tax bill, and it is available every single year, but only if you execute it before December 31st. The second version is tax loss harvesting, and it is for the retiree who has gains they need to offset or who is holding investments that have dropped below what they paid for them. Here you do the exact opposite. You sell the losing investment to lock in the loss, and that loss cancels out capital gains elsewhere in your portfolio, dollar for dollar. If your losses end up exceeding your gains, you can use up to $3,000 of that excess to offset your ordinary income, and anything beyond that carries forward to use in future years. For the retiree who took a big gain somewhere this year, harvesting losses before year-end can erase the tax on that gain entirely. Here is how this trap drains a six-figure account when it is ignored. The retiree with a large taxable brokerage account built up patiently over decades is usually sitting on enormous embedded gains. If they never harvest in their 0% years, those gains just keep compounding and eventually get sold in a high-income year or get forced out in a high tax bracket, costing 15 or 20% in tax that could legally have been 0. And on the other side, the retiree who takes a large capital gain without ever checking for offsetting losses pays full freight on a tax bill they could have legally cut down. There is one rule here you absolutely cannot break, and it is called the wash sale rule. If you are harvesting a loss, you cannot buy back the same investment, or one that is substantially identical to it, within 30 days before or after the sale, or the IRS will disallow the loss entirely. The clean way around it is to buy a similar but not identical investment so you stay invested in the market. Now note this carefully. The wash sale rule applies only to harvesting losses, not gains, so the tax gain version does not carry that restriction. And the deadline for all of it is that the trade has to settle within the calendar year. So do not leave this to the final trading days of December, when the markets close early and settlement timing gets tight. Now, I want to show you why these 5 traps belong together on one single checklist, because they are not 5 separate problems at all. They are one interconnected machine, and the same number sits right at the center of every one of them. That number is your income for the year. The required distribution in Trap 1 forces your income up. That higher income in Trap 2 pushes you toward an IRMA A cliff. The Roth conversion in Trap 3 is a tool that deliberately raises your income today in order to lower it forever. The QCD in Trap 4 lets you satisfy that forced distribution without raising your income at all. and the capital gains moves in Trap 5 let you either harvest gains cheaply in a low-income year or wipe out a tax bill with losses. Every one of these is a lever on the very same dial. Pull them in the wrong combination, and you stack income on top of income, blow straight through a Medicare cliff, and hand the IRS thousands of dollars for nothing. Pull them in the right combination before December 31st, and you can take your required distribution, support your charity, convert money into tax-free growth, harvest gains at 0%, and keep your Medicare premiums flat, all in the very same year. The difference between those two outcomes is not luck, and it has nothing to do with how much money you have. It comes down entirely to whether somebody laid out the checklist for you before the deadline arrived. So here is your year-end checklist. In plain terms, all 5, all due by December 31st. 1. If you are 73 or older, confirm that you have taken your full required distribution from every traditional account or face a 25% penalty. 2. Know where your income sits relative to the next IRMA AA cliff, because this year's income sets your Medicare premiums 2 years out, and a single dollar over a threshold can cost you thousands. 3. If you have room left under your tax bracket, seriously consider a Roth conversion before the window closes for the year, because that low bracket space does not roll over. 4. If you are over 70 and a half and you give to charity, use a qualified charitable distribution to satisfy your required withdrawal without raising your income, and start it early enough to clear by the deadline. And 5, look hard at your taxable investments for either tax gain harvesting in the 0% bracket or tax loss harvesting to offset your gains, and get those trades done before the year ends. 5 moves, 1 deadline, and every one of them hits the 6-figure account harder than the small one, which means the more you have built over your lifetime, the more you have on the line to protect. If this video was useful to you, the most helpful thing you can do right now is hit the like button, because that is the single signal that tells the YouTube algorithm to put this in front of more retirees who need to see it before the deadline passes. Subscribe if you have not already so the next breakdown lands in your feed. And if you know a friend, a sibling, a parent, or a neighbor who has a 6-figure retirement account and may not realize the clock is ticking, send them this video directly, because these are exactly the kind of moves that can only be made before December 31st, and once that date passes, there is no fixing them. YouTube is also showing you a video right now on the screen because they think it is the next thing you need to see. Go ahead and click it. I will see you in the next one.